Hey, I'm Joe Herbert from Joe Herbert Realty, your Erie real estate agent. And today I'm here with Gosha Riley of Movement Mortgage, one of the best loan officers in Erie, PA, by the way. And today we want to talk to you about what you will get on a closing statement when you come to your closing and actually buy your house. So, Gosha, say hi to everybody.
Hi everyone, I'm here to try to explain everything that goes into your closing costs besides of your down payment.
Awesome, and that's a great point. So when you buy a house, right, you're going to put some money down on it, you're going to get a loan for the rest, but you have these closing costs, and so this is extra things, and we want to educate you on that. So here we go, typical closing costs when you're buying a home. So let's start right here, Gosha. Courthouse fees. Tell us a little about what courthouse fees are.
Courthouse fees are typically the recording of your deed and the recording of your mortgage. That's what the courthouse charges you. Anytime you buy a house, it becomes a part of a public record and it has to be all recorded. You pay it no matter who you go with. Anytime you buy a house, it's just you pay those court fees.
Awesome, right? So once those documents are made, everybody signs them, they get filed at the courthouse. That's what makes them official and legal, right?
Yes, it does.
That's amazing. Let's talk about this right here. What is an appraisal fee?
Appraisal fee typically runs about $500 to $600, depending on the loan type. What appraisal is, when we are lending money to someone to purchase a house, we want to make sure that A, the house is worth as much as we're lending them for, and B, that the house is in a good condition and the house is not falling apart. Because if you're getting a 30-year mortgage, we want to make sure that the house will last you for at least that long, since you're going to be making payments on it. So when we start the loan process, we order the appraisal. That fee is one of the only fees that will be due up front, because the appraiser is a third-party worker. They like to get paid at the time of service. Sometimes if appraisal is bad, deal falls apart, the appraiser did their job and they would like to get paid for it. So that's something, when we order the appraisal, you get an email, you go online, pay for it, appraisal gets done. Occasionally there's a re-inspection if the appraiser picks a thing or two that's not right with the house. The seller typically is responsible for the repairs, and we send the appraiser back to make sure that all the repairs were done.
Perfect. And let me just add on that. The buyer is usually paying this because you're the one getting the loan. So that's why the seller doesn't pay this. It's part of getting that loan approved for you. Correct. So let's talk about lending fees, lender fees. Tell us a little bit about that.
Lender fee, it's typically a processing and underwriting fee. That's what you'll pay the bank to process your loan. There's a lot that goes on into a mortgage loan, a lot of paperwork, a lot of staff. So whether you go to the bank, broker, lender, you will pay some kind of processing and lending fee. It's typically a flat fee, typically somewhere around $1,500, and that's basically what bank charges you to handle your mortgage loan.
Outstanding. And you touched on something there, and I'm going to throw a curveball at you here.
Oh.
So you mentioned like whether you go to a bank or a broker. Just quickly, could you tell the audience what's the difference if they go to a local bank or they go to a mortgage broker? Let's talk. Well, actually, I will say this. So mortgage brokers go out to all kinds of banks to get you a loan, correct? And if you go to a bank, you're typically using that bank's products.
Correct. So there are lenders, retail lenders, there are banks, and there are mortgage brokers. And the main difference is, bank does a little bit of everything. Okay,
Right,
if you go to the bank, you may not
checking
get
accounts,
checking accounts,
cards.
savings accounts, car loans, and everything in between. A broker is basically a person who works with multiple banks, and they're like I don't want to call them a middleman, but in a way they are. They have access to different avenues. Mortgage lender, we do mortgages and mortgages only. We do also have a broker channel for programs that are not available through Movement, so we do a little bit of both. But as a retail lender, we specialize in mortgages. So our process is very streamlined. We handle it quickly. And
all right. So I didn't mean to take you guys down a rabbit hole. Let's keep going. Okay, so points. And I said I was going to make this joke. The NFL's coming up, Super Bowl. We're not talking about points at the football game. Tell us what these points are on a closing statement.
Points are optional. When you go under contract, you typically will discuss your rate in terms of the loan with your loan officer. Points is something that you can choose to pay to reduce your rate. You don't have to do it. Sometimes but you have to be careful when you're getting estimates from different banks. For instance, when you're shopping around, some estimates will automatically include a point or point and a half. because some lenders want to make the rate look really good because we're in a rate focused society typically. So always be careful and see what those points are, because you do not have to pay points. If you do pay points, you will get charged extra. Typical rule of thumb is if you break even within the first 3 years of the loan for what you pay in points versus how much you're saving per month, it may be worth it to pay points, but if it takes any longer than that, a lot of times it's not worth it.
And I'll expand on that. Typically today in the United States, homeowners are staying in a home an average of about 8 years. So you brought up a good point. If you don't think you're going to be in your house that long, then it may not be worth paying the points. If you think you're going to be there in 5, 6, 7, 8 years, it's probably worth it. And tell the audience, what is a point? What is 1 point? What does that mean?
1 point, it's 1% of your loan amount. So if your loan is for $120,000, that's what you're borrowing. 1 point is going to cost you $1,200. And how much is it going to buy down? We look at the price matrix and determine that. Every day might be different story, so there's no set amount that you're going to buy down that rate. But also, a valid points to bring up here is also, when we're in a higher rate environment, it might not always make sense to buy those points, because if the rates drop, let's say in a year, and everybody would like to refinance, you'll never recoup that money that you pay in points. So I would be cautious about points.
That's why it's always good to work with a loan officer like Gosha, because she's been doing this a long time. And you can say, hey, Gosha, tell me, is it worth it? What's it going to cost me? What am I going to save? She'll do the math for you. That's why you should work with Gosha.
Well, thanks, Joe.
Absolutely. So let's check this out now. Okay. What happens when you buy a house is your attorney or your closing company is going to do a title search, because they want to make sure when you get the deed, all the loans are taken care of, taxes, everything's paid, so you're getting a clean deed. So tell us about title insurance and title work.
Title insurance, title work, and all the legal fees that your settlement company will charge you are probably the biggest expense on that cost estimate out of all these expenses. It is the fee that you will pay for someone to check the title on the property, to make sure there are no liens against that house. I've run into situations where there are liens against the house and they have to be cleaned off first before someone can buy it. Also, title insurance is super important, because as a lender, we want to make sure that there's a clean title on it, but you as a buyer, you want to make sure that you have the buyer's insurance, title insurance on it as well. So in case, let's say a year or two down the road, someone comes back and say, hey, 30 years ago, there was a lien against this title that was missed in the initial title search, you're covered. Besides that, your title company is going to handle your closing. They're going to communicate with your seller's attorney. They're going to do all the proration. So they do a lot of legwork as well. There's some administrative fees added to it, because they will do a lot of work to make sure that you can get this house, and they take care of your closing as well.
Awesome. Great. Next, we're going to talk about transfer tax. Tell us what it is.
Transfer tax?
How much it is.
It is typically in Pennsylvania, it's 1%.
The county charges 1% and the state charges 1%.
Correct, and it's typically split between buyer and the seller. So most common scenario that you will see, this will be 1% and the seller will pay for the other 1%. It is just a standard transfer tax in Pennsylvania that everybody pays. So if you're buying a house for $300,000, you're going to pay $3,000 in transfer taxes.
1% of the purchase price. Awesome. Now we're down here to prepaids, okay? And we're going to talk about how that relates to your insurance and your real estate taxes.
So when you buy a house, and if you choose to escrow your taxes and insurance, we start a separate account. It's almost like a savings account. I like to explain it to my clients.
That's a good way to say
where every time you make your mortgage payment, you're going to pay on principal and interest, but you're also going to pay into your escrow. So in the beginning, we typically collect your full insurance premium for the 12 years, because insurance and taxes are always paid ahead. So we collect 12 months of your homeowner's insurance, plus extra 2 months just to have a cushion, and I'll explain why in a second. And also, the attorneys will do the legwork of how much you may owe the seller, because if you buy a house in October and the seller just paid the school taxes they were due in August, they prepaid for a year ahead. You might have to pay the seller back a little bit, which that's different than escrows, but similar. I'm getting there. But for your escrow, you also have to prepay enough, so when next August rolls in, you have enough money to so
Yeah.
we can send that money to the
A
tax
good
office.
way to look at it is, let's say you bought your house in the middle of the year, right? And 6 months later, you're getting the tax bill, but you've only contributed 6 months to it. So we're gonna take 6 months at the closing and add it in there ahead of time. So when the bill comes, you'll have 12 months in that escrow account to pay the tax
To
bill.
pay the taxes or insurance.
Alright.
Same with insurance, yes.
Alright. Does that
And
make sense?
It does make sense. Yeah, it probably made it easier than I did.
So that's your prepaids, right? Some of that will be paid at the closing.
If you're not escrowing, it will look slightly different on your
That's
on your
right.
CD.
And when
but-
Gosha says escrowing, like she said, it's basically you're putting some money aside every month in a savings account. So when you get those bills, and by the way, that money goes to the bank.
Correct.
The bank's the one that's holding that money for you. So when you get the tax bill, the insurance bill, you just send it to the bank. They pay it.
It's done automatically anymore. You don't even have to
Yeah.
forward it. But yeah, back in the days, you
Okay.
would send it to the bank.
Awesome.
Yeah.
So let's go up here and talk about prepaid interest.
Prepaid interest, it's per diem interest that you will be paying for the remainder of the month that you close on your house. And here's an interesting fact. If you close on a house, whether you close on a house January 1st or January 31st, your first mortgage payment will not be due until March 1st. So you basically get a free ride. Depending if you close on, if you close on January 1st, you're going 2 months
Yes.
before you make your mortgage payment.
But guess what?
So the prepaid interest will be higher.
That's right.
Because you're gonna pay it for 30 days in January.
Yeah.
Okay? Which is typically still lower than your mortgage bill. If you close January 25th, you only pay that prepaid interest for 5 days or 6 days. So that's just to make up for the difference. And same, that's why we collect 14 months of homeowners insurance, because there may be 2 months that go by when you're not making that mortgage payment, but your homeowners insurance will be due on the date that you closed on a
Yes,
house.
and correct me on this if I'm not correct, but you are paying interest in arrears. So that what that means is for the whole month that you're using the bank's money, when you make that mortgage payment at the beginning of the next month, the interest is for having used the money the previous month. And as Gosha said, your first mortgage payment won't be due until you've owned that home for a full calendar month.
Correct.
Okay, so now, last but not least, number 8, prepaid interest. Tell us about that, Gosha.
So when you're purchasing a home, you're gonna have a closing date, and it's gonna be, let's say, January 15th. Your first mortgage payment will not be due until March 1st. You always have to own a home for the full month before your first mortgage payment is due. So depending whether you close January 1st or January 31st, there are 31 calendar days in there, and you will pay prepaid interest for the remainder of that month. So just to give an example, you're closing beginning of the month, your prepaid interest will be higher because you're paid for, let's say, 25 days, versus if you close January 30th, you're only going to pay prepaid interest for 1 day, which is much lower.
Gotcha. Yeah, makes sense. So yeah, when you make that payment on March 1st, you're paying interest for all of February. But you bought the house in January, and the bank wants interest for the time in January you were using their money, and so you pay that at the closing. This is awesome. Thank you so much.
That was great, Joe. Thank you
Yeah,
for
so
having me.
Gosha, if people want to buy a house this year and they want to get a fast pre-approval, they want to work with a great loan officer, you, how do they get a hold of you?
They can give me a call, 814-392-2265, or they can visit my website, eriemortgagegirl.com.
Erie Mortgage Girl, that's awesome. And by the way, I've sent a lot of clients to Gosha. She's great to work with. Nothing ever goes wrong. That's why I love working with her. I'm Joe Herbert, your Erie real estate agent. Thanks for watching.
Thanks, guys.